In this video, you're going to learn exactly when the Federal Reserve is going to cut rates, and you're going to learn exactly how to track it.
Hey, if you want to bundle up on the programs on Building Your Wealth, email staff@meetkevin.com. We do have some bundles on the website, link down below, with that price increase happening tonight. But if you send us an email, we'll make sure you get taken care of. Yesterday, Elon Musk replied to a tweet suggesting Jerome Powell will not lower rates for 2 years, and that is not what he said. In fact, I replied to that chain. It's right here. It says, "Good morning, everyone. Jerome Powell said the Fed's forecasts have been wrong on inflation in the last 2 years." And he actually said economists' forecasts have been wrong the last 2 years. But anyway, now he's saying rate cuts aren't going to happen for another couple of years. That's not what he said. He was responding to a 2-year projection statement. Elon replies here, he is wrong. I thought it was interesting. I gave this reply here. I broke down the formula again for those on Twitter, which is probably a little too complicated for the Twitter world. Twitter world seems to like, is it going up or is it going down? As soon as it gets complicated, people don't like it as much. But anyway, I provided it anyway. We know this, right? Jerome Powell's formula for reducing rates, which is actually what he reiterated, is cut as inflation expectations fall. Expectation plus the target real rate equals the nominal rate. In other words, we get to the 5% when you add together 3% plus the target rate. That's how you get to some sort of inflation adjusted rate where we sit now to have sufficiently restrictive policy. And when this number 3 falls is when we expect to cut. We actually, if you look at the 5-year break even, we haven't gotten to that cut level yet. We've talked about this, golly, probably for at least a year now, but we've talked about the 5-year break even as being this tool that'll indicate when the Federal Reserve is likely to cut based on when the Federal Reserve cut the last time in the last cycle, ignoring COVID. And so when was that? You go back 5 years and you go to 2018. And when you go to the 2018 cycle, you can see what level we have to be at on the 5-year break even to, in my opinion, expect a rate cut from the Fed this cycle or this time around. So in other words, we can actually rely on history as potentially a leading indicator for when the Fed is going to cut. And that's provided by this chart right here on screen. Oops, I made it hide. Hold on one sec. There we go. This chart. Okay, cool. So let's manipulate this chart a little bit. And I think this is very important. Now, as I mentioned this chart, I want to remind you that phase 1 of that coupon expires today. Remember, there are going to be 4 phases of price increases. The first one on screen now starts tonight. And that's because we're getting ready for a massive new release of a bunch of new lectures and various different programs. Remember, we've got Zero to Millionaire Real Estate Investing, Stocks and Psych, Property Management, and then on the income side, we have the getting SH90 done faster with AI, real estate sales, and building wealth with YouTube. So take a look at those, linked down below. First phase expires today. But take a look now at this chart. This chart gives you your guidance for exactly when the Federal Reserve will cut. And I think people really forget this. But that's okay. If we know about it and other people don't, then it gives you alpha, right? It gives you market insight that other people don't. And one of the reasons I've been going long the market, certainly since the probably around mostly been along the market since about the middle of last year, and really heavy into the chips and tech starting in about November. But if you take a look at this really gives you your guide of, okay, well, as long as we're trending down on these, the rate cuts will come rather than a Paul Volcker. In order to get a Paul Volcker, you need inflation expectations to do this, which is what they had done during 2021. This is why going into March of 2022, everybody feared Paul Volcker so much and we saw such lows in the market, because the fear was if these expectations continue on forever, we're screwed. But the opposite happened, right? Expectations fell. Now, what level do they need to fall to see cuts? Well, let's first mark the next or the last time the Federal Reserve has cut. And the last time the Federal Reserve cut was, well, over here during COVID, right? This was our emergency Sunday 2-rate cut. And you could see this occurred right around the time the inflation expectations were over here in a pit. But we're not going to look at this. This is really when COVID started, and over here is when you had the Fed rate cuts and unlimited bailouts, and all of that happened over here in the mess. Let's ignore that for a moment. And let's go over to the last time we had some sort of pivot from the Fed, which was really the end of 2018. And so your pivot was really about here. Let me see if I can get that to be exactly perfect for you. Give me one sec. I'm just going to look at the data. I'm looking for, okay, there it is. It looks like it was about 1.70. Let me put that on screen for you here, because in the back end, I can actually see, when I hover over, I can see what date these are. But anyway, it was about 170. So yeah, right about where I had it seems to be about right. So 170 is right about where the Fed last sort of pivoted. 170 is right about here. There you go. And so you can see where we are now. Where we are right now leaves over here at 2.2, leaves a little bit of work to do. In fact, it leaves about 50 basis points of work to do. 50 basis points is about the difference between what we see now and what we saw during the banking crisis. About a 50 basis point difference over here. It's also this difference that we saw if you ignore sort of the March crisis here and you go back and say, well, how about from today back to when did we have 50 basis points? Well, it was actually in September. That's about 9 months. 9 months is quite a while. If we continue at that pace, it would take roughly 9 months for the Fed to get to that cut level. 9 months would be consistent, actually, though, and it's kind of creepy, but when you align it, a 9 month decline in inflation expectations would align with March of 2024, Q1, which how interesting. Q1 2024 is actually where a lot of people right now are placing their bets for Federal Reserve rate cuts. And that's probably where we're going to see the rate cuts, whether it's January or March of 2024. It'll probably be punted to then. Much like recession expectations are being punted to 2024. Currently, you have about a 34.7% chance of being at your first rate cut by March of 2024. But if you actually add in the odds of those people who think you'll already be on your second rate cut, 14.6%, and your third rate cut, 2.2%, you're at about a 50.1% or 50.1, sorry, 51.5% chance of rate cuts by March of 2024 based on what the market is pricing in now. Whereas most of the market, and when I say most of the market, I can give you the exact math on that. Most of the market is actually 75.6% thinks we will still not have cut rates by January of 2024. Now that's actually good. That shouldn't discourage anyone or make anyone sad. The reason for that is because it means the market has already priced in that we're not seeing cuts really until the coin toss potential. So let's write that down clearly here so we can all see that. So we have a coin toss potential of cuts by March 2024, which is consistent with this chart that we just explained, which suggests that we have about 9 months to go. Now, this is a pretty bumpy chart, and the volatility will suggest that we may get there faster or we may get there slower. But I believe that this is really the tool the Federal Reserve is using in the background to guide their decisions. I believe this because if there was one thing that screwed up the Federal Reserve in the 1970s, it was failing to respect this chart. This chart failed the Fed in the 70s because they ignored it. Had they paid attention to this chart in the 70s, they would have undertaken the correct interest rate policy much earlier. But they didn't pay attention to this chart until about 1981. Now that's remarkable because in 1981, you can go back through the historical archives of the exact transcripts, not even the minutes of what they said at the meeting, but the exact transcript. And you can look at the transcript of what the Federal Reserve said. And in 1981, the Federal Reserve all of a sudden realized they had screwed to maintain inflation expectations. They screwed up. And in order to actually control inflation again, they needed to lower inflation expectations by aggressively raising rates. And that's ultimately what became Paul Volcker. So Paul Volcker came about by raising rates aggressively, realizing they had not killed inflation expectations yet because they raised rates aggressively in 1980, but they didn't go far enough to get that chart to come down. So even though they cut rates stupidly too early in 81, they ended up having to hike rates substantially again starting in late 81 and through 82, causing this near 20% interest rate fight versus a near 20% or 20%, near 20% inflation rate, near 20% Fed funds rate, just to crush inflation and create a nasty recession. That was the definition of getting Paul Volcker. And it all resorts back to one chart. And that was anticlimactic. There we go. That chart. And this chart, if there's one thing you want to look at on your trading view on almost a daily basis, it's the 5-year break-even chart. You could just type that in, 5-year break-even. It's the difference between the tips and the 5-year treasury bond. So there's a lot of volatility since it basically moves every single day. But you can see this on TradingView as well, or really wherever you want to look. But I would encourage watching this. And when this level gets down to about 1.7, which I think will be somewhere around March of 2024, I expect the Fed to pay attention to this chart and cut rates. But you can see we're not there. Are we potentially consistent with a pause? Only to the extent that this does not keep rising. I think you can actually indicate or use this as a tool to suggest whether or not the Fed will hike or not in July. I think that if in July, we are still range bound. So let's consider that for a moment. The Fed, let's say it's the day before the Fed meeting in July. And let's say that the inflation expectation level has been bounded between this range right here. I think the Federal Reserve might be convinced to hike rates again because they need to drive these expectations down again. They need to get this to come under this to slowly start trending to 1.7. And if they aren't seeing this level come down, they might need to hike again. Now, if by the time we have the next meeting over the next, let's say, or call it over the 3 weeks before the meeting. So in other words, within the next couple of weeks starting, and then over the next 3 weeks thereafter, which would be the 3 weeks before the meeting, since the meeting's about 4.5, 5 weeks away. If all of a sudden inflation expectations are trending down and they're within this range, we're at about a 2 or a 1.9 for inflation expectations. I believe it would make sense for the Federal Reserve to say, hey, look, we're going to wait until September. Or they might say, we're just going to skip another meeting, whatever, right? That would make logical sense based on this chart. So far, this chart has guided all of the Fed action. And we don't need to go through the history of it because, we know practically it has worked. But I mean, you could consider this by looking at, look, it's really high. Let's get 75 basis point hikes. Okay, it's moderating. Let's go 50 BP hikes. Okay, it's moderating even more. Ignore the banking crisis for a moment. It's moderating even more. Let's go with 25 basis point hikes. Okay, it's pretty stable. Let's go with a pause. Okay, if it stops or it unanchors, let's hike again. What's it going to take to get down to that ding rate cut? So we'll see. But I believe this is a very fascinating tool that really everybody can use. And quite frankly, many analysts, I think, are under-analyzing and underusing. But that's okay. I think when other people aren't using those sort of tools, they give you an edge in the market. Finding those sorts of edges or things that we do on a daily basis, whether it's in the real estate investing chat or our stocks and psychology of money chat or productivity chats that we have every day the market is open in the courses linked down below, where we're going through earnings calls, we're going through reports together, we're doing fundamental analysis. So remember to check that out via the link down below because we've got a pricing increase happening tonight.